Thank you for tuning in to another edition of the Vulcan Report. This is a special report for what's happening in the Bitcoin and altcoin space. Here's an open letter from Interactive Brokers to the chairman of the CFTC, which is the Commodity Futures Trading Commission. And it's entitled Dangers of Clearing Bitcoin and Cryptocurrency Derivatives in Same Clearing Organization as Other Products. Dear Chairman Giancarlo, I am the chairman and founder of Interactive Brokers LLC, a futures commission merchant and broker-dealer with over $3.8 billion in regulatory net capital and over $1.2 billion in client margin funds. Interactive Brokers Group is publicly traded on NASDAQ with a market cap of over $22 billion. As a CME clearing member, which is the Chicago Mercantile Exchange, we are deeply concerned with proposals that would allow Bitcoin and other cryptocurrency derivatives to be cleared in the same clearing organization as other products. This letter is to request that the Commission require that any clearing organization that wishes to clear any cryptocurrency or derivative of a cryptocurrency do so in a separate clearing system isolated from other products. There's no fundamental basis for valuation of Bitcoin and other cryptocurrencies, as they may assume any price from one day to the next. This has been illustrated quite clearly in 2017, as the price of Bitcoin has increased nearly 1,000%. Cryptocurrencies do not have a mature, regulated, and tested underlying market. The products in their markets have existed for fewer than 10 years and bear little, if any, relationship to any economic circumstance or reality in the real world. Very interesting wordage being used. Margining such a product in a reasonable manner is impossible. While the buyer, the long side of a cryptocurrency futures contract or call option could be required to put up 100% of the value to ensure safety, determining the margin requirement for the seller, the short side, is impossible. Instituting daily price move limits on cryptocurrency derivatives does not solve the problem. He's talking about imposing lock limits, which currently are operational in certain commodity futures products. Not all commodity futures products have these lock limit moves, but traditionally you have them in like the grain markets, for example, corn, wheat, soybeans, things like that. Also, you have it in the meats and various other sectors too. In a runaway upward market, for example, like the silver market in the 1980s cost the Hunt brothers, the futures price gets lock limit up day after day with little or no trading, and the short sellers are unable to cover, leading them and potentially their clearing firms to ruin. For those of you who are unfamiliar with what is being said here, a lock limit move will make it so that you may not be able to unwind your position and have to suffer mounting losses each day that the market locks limit. You've heard me talk about this in my videos from time to time when pork belly futures locked limit every day all summer back during the election of Barack Obama back in 2008. They locked limit every day, every freaking day. And then just like at the turn of a dime, the market just stops and just collapses. And it takes about a month for it to erase the lock limit moves of the entire summer. It was just crazy. So they delisted it, meaning that it still works. The market's still there. They just don't allow retail customers to trade it. So that's what they're talking about there. Also, cotton around 2010, 2011, one of those points. I don't remember exactly when it was. I know I participated in it. Cotton would lock limit all the time. It went up to like 300 bucks from trading like 60 on average. It was just crazy. So in futures that can happen. Also, there are lock limit up and lock limit downs. In a lock limit up, shorts can't cover. In a lock limit down, longs can't cover. So, example, um, we'll use something everybody knows. Let's say there was an iPhone futures market. All right, and let's say the cost of the new iPhone that comes out is $1,200 if you want the top of the line. All right. Some people may say, I'm going to sell that. I'm going to sell it short. I have iPhones. I'm going to sell them short because I think that the price is going to fall. So I'm going to go ahead and sell at the high price and buy it back at the low price and thus keep the difference. What happens is in a rising market, so let's say the phones start off at $1,200 and then tomorrow now they're going for 1,500. The person who's short who sold at 1,200, remember, promises to deliver at that price. So if the going price now is 1,500, he's losing, is already down $300. So let's say the next day now instead of 1,500, they're going for 2,200, and then the next week they're going now for 3,500. The person who is short is getting destroyed, and they cannot unwind the trade to say, all right, I'm just going to get out now because who knows how high this thing can go. No, a lock limit only takes long orders. You can't get out of the trade. It's lock limit up. So you can't get out. And vice versa when the market's locking limit down, when prices are collapsing. If you're long, you can't get out. It's devastating, put it that way. You trade futures long enough, you will be exposed and find yourself in a lock limit situation. I have been in it before. I've been in fast markets too. You hear me talk about the famous one where I was in a fast market with cocoa futures, and I couldn't get a fill, not even with a market order. It was crazy, it was bananas. At the time, that's when my homie Oscar Caboni on YouTube, he was clearing paper at one of the largest clearing firms in Chicago at the time. So he was clearing paper for New York and Chicago customers, and he remembers that because I think he was actually in the filling orders in the pit, in the cocoa pit. We laugh about it all the time. I'm like, man, I'm still waiting for my fill. Anyway, that can happen to you. So just imagine, you know, taking this now to the crypto space with the price swings and the volatility we've seen in a lot of these quote unquote coins. It's been crazy, man. So can you imagine being caught in a situation like that and you can't get out of the market? That's you talking financial ruin, man. It's you talking about jumping out the window type stuff. Okay, back to the letter. So, if the Chicago Mercantile Exchange or any other clearing organization clears a cryptocurrency together with other products, then a large cryptocurrency price move that destabilizes members that clear cryptocurrencies will destabilize the clearing organization itself and its ability to satisfy its fundamental obligation to pay the winners and collect from the losers on other products in the same clearing pool. That's correct. He's speaking facts. Accordingly, even clearing members who do not wish to clear cryptocurrencies because they judge the risk to be too great cannot isolate themselves and their customers from a potentially catastrophic loss from cryptocurrency risk at the clearing organization. That's correct. So even if you avoid dealing in that space, your clearing firm, if they clear in that space, you are tied to it. So the systematic risk comes your way, whether you want to or not. Thus, it is no answer for the proponents of clearing these products to suggest that objecting clearing members can simply charge very large margins or not offer cryptocurrencies at all. At a central clearing organization, all members are at risk for the activities of any member and of the clearing organization itself, which is very true. That's why, you know, they have the whole margin call situation. But now there's something special that they have in the futures arena that they don't have with trading stocks, and that is span margin. Span margin is a how do I explain this? Span margin is magic. That's basically what it is. It's a set of magic, arbitrary calculations and algorithms that determine what your initial and maintenance margin will be on a given trade because they evaluate the risk to yourself and to the firm, and then they determine what that's going to be. It could be outrageous. I've seen outrageous span margins back during my broker days. So it's whatever, and it's impossible to know what those margins will be until you go through that process. So what they're saying here is that it's impossible for you to determine that, and it will put many people at risk. I know when I ran the trade desk at one point, every day, every morning that I would come in, I would have to look at what is called the daily run, and on the daily run would have the firm's clients, every client, um, every self trading person, meaning someone who's working independently without a broker, as well as the broker clients on there too, people who use the broker. So self-directed accounts, broker assisted accounts, had to look at the runs for everybody, even my own accounts, and we had to determine what's going on, who's on margin call, things like that, and you have to make those margin calls. Say, look, man, pony up cash, or we're pulling the trade, whether you like it or not, win, lose, or draw. In addition to that, as far as looking at variable risks, uh, the firm had basically, and this is all brokers, they have error accounts. So if there was any errors done on a trade, like you pushed sell when you meant buy, and there was a inadvertent loss on the trade, you would have to eat that if it was a broker assisted account. And if there was an error that actually netted a profit, then you would split that, and that's how that worked. Um, so any errors that were positive, the broker kept. Any errors that were negative, the broker had to eat. That's just how that went. And sometimes you even would split stuff with the client. It's dependent on your relationship with the client. All right, so that's some of the ways that risks were balanced out. Okay, unless the risk of clearing cryptocurrencies is isolated and segregated from other products, a catastrophe in the cryptocurrency market that destabilizes a clearing organization will destabilize the real economy as critical equity index and commodity markets cleared in the same clearing organization become infected. The only way to protect clearing organizations and their members and the financial system as a whole from the unique risk inherent in clearing cryptocurrencies is to require that they be cleared in a separate clearing system isolated from other products. We'll be happy to discuss this with you or to provide any further information at your convenience. All right, so whether you like it or not, from a business standpoint, this letter is on point. And this letter is dated November the 14th of 2017. Thomas Petterfee, or Peterfee, or however you want to say it. All right, and this was printed in the Wall Street Journal. Okay, so this is an open letter. So whether we like it or not, folks, it's coming. All right, cryptocurrency futures are coming. You already got equity products in the making. Also, GBTC is the only real valuable ETF you can trade right now, but more are coming and will be established. Right now, you got equities that like small penny stocks that operate in the blockchain space, and you can trade them. You hear me talk about them a lot during the end of day reports and sometimes in the pre-market reports. So they're coming. All right, they are coming. How they're going to do it, how they're going to clear it, how they're going to share the risk is all up in the air. But I do know this: within a month from now, we're supposed to have the first futures product. So I don't know how it's going to work. Because it's a new space and because of the risk involved and the liquidity issues, I wouldn't be surprised if the margins were astronomical. For those of you who don't know, the initial margins on a lot of the products that you enjoy trading today for a couple of hundred bucks in margin used to be tens of thousands of dollars in margin. I remember at one point the Nasdaq futures contract and the S&P was $30,000 to $40,000 of initial futures margin just to trade one futures contract. I will never forget it. $40,000 was that Nasdaq futures. I will never forget that. All right, 40 grand, which means you had to have 40 grand in your account when you initiate a trade, whether it was long or short. And that's just one futures contract. For those of you who are not in the know, the E-mini NASDAQ 100 is $20 per point. And I'm trying to remember what the big NASDAQ was. It may have been the same. I just can't remember. But anyway, it's the equivalent of trading 2,000 shares of a stock. The E-mini S&P 500 is $50 a point, and it's the equivalent of trading 5,000 shares of any stock. Okay? So that's how you look at it. The mini Dow futures contract is $5 a point. So it's the equivalent of trading 500 shares of any stock. All right, so those are the benefits of the futures contracts. They're leveraged instruments, and you can go long or short without having any pattern day trader rules or anything like that. You can day trade the Dow, the S&P, or the NASDAQ futures contracts in and out a million times a day. You don't have to worry about, pattern day trade rules smacking you in the face. So that's the benefit of the futures. So because they're leveraged instruments, imagine what this Bitcoin futures contract is going to be. Right now, Bitcoin futures are staring at the face of the 7,000 mark, on their way to 8,000. All right, just for one coin. So can you imagine what the initial futures margin will be? I'm sure they're going to have a mini Bitcoin, and who knows what other coins. I'm sure they may have an Ethereum to come out. I know it's going to be a Bitcoin, and I'm sure right behind that is going to be an Ethereum. It's going to have to be. All right. So those will probably be your first two, Bitcoin and Ethereum, or maybe they'll come up with some other, like some index. Like they'll come up with an index, and they'll have like the top 100 coins or something in it, and they'll have to make an index like your Dow and stuff. So they have to have a crypto index. I don't know what they'll call it, but there will have to be an index. Bitcoin will have its own, and then I'm sure they'll have some kind of crypto index, like a fund that trades the top, 100 coins at any given time. I don't know how they're going to do it, but that will probably be the best way to go about doing it. So this is the future, folks. Got to get ready for it, because ready or not, here it comes. And with that being said, remember pulsewavetrading.com. Come and learn what all this stuff is about. Learn how to trade in the new world of algorithmic technology. Learn how to rage against the machine. PulseWaveTrading.com. 7-day free trial includes the free study course and live coaching and tutoring with yours truly. And remember, bulls make money, bears make money, and pigs get slaughtered. So remember to take what you can and give nothing back. Peace.